and welcome to Hardman Talks. We are recording this on Friday, the 23rd of September, 2022. I'm joined today by Keith Hiscock, CEO of Hardman & Co. Keith, you've just published an insight piece entitled Macro Issues Dominate Investor Sentiment. This very week, we've had another substantial rise in the base rate by the Bank of England and a mini budget. So you make a number of interesting points that are useful for investors. And I think we're all a little bit spooked by this term recession. So how much should we be reading into this and what should investors be looking out for?
Thank you, Larissa. Nice to talk to you today. Let's first of all briefly explain what the term recession means. It gets thrown around a lot. What it means is, for economists, is it's defined as 2 quarters in which GDP, gross domestic product, goes backwards. Now, the 2 quarters is essentially arbitrary. I mean, it could be 3 quarters, 5 quarters, 1 quarter, whatever. But it's in general use, it means 2 quarters of GDP going backwards. Does that spook one? Well, you could have 2 quarters in which GDP declines by 0.1% in each quarter, and the measure is year on year. So it's the first quarter of this year against the first quarter of last year, for example. 0.1% for 2 quarters. I don't think people would notice that, to be honest. Why GDP? Because it's the easiest way to measure the output of an economy. GDP is a measure of the wealth created in the year. There are some economists and some people outside economics who would prefer to use a happiness index as a kind of measure of the success of an economy and the success of government policy. There are various approaches to that. Nobody can agree on what the components might be and what weighting they are. So generally, the term used is GDP. Why does it matter if we go into a recession? Well, if we go into a recession, it means we've all got a bit less money to spend. It means that the government's got less money to spend. It might try and offset that by borrowing from the future, by increasing its borrowings, or it might try to offset that by putting taxes up. What's the Bank of England forecasting? Well, the Bank of England is forecasting quite a prolonged recession. The last quarterly report suggested we'd have 7 quarters of decline, and a reasonable decline in historic terms. We've already had 1 quarter decline, and they're making it pretty clear yesterday, that this quarter will be a decline as well. From investors' point of view, I think there are 2 things to think about. First of all, not every sector sees the same shape of recession. So it might well be that some sectors don't decline whatsoever. So if you think back to the Great Depression in the 1930s, radio and cars carried on growing. Maybe they would have grown faster without the Depression, but they carried on growing. The second aspect, I think, for investors is to think about the timing. So not every sector will hit the bottom at the same time. So it would be easy to say, oh, I'm seeing an improvement from this company's results, and from that read across to other companies in other sectors. That may not be the case. You know, one company or one sector could well be coming out of a recession whilst another one is still going into it. So I think those are the things investors need to take into account. We're going to see a relatively deep recession by historic terms, but don't expect the shape of the recession for individual sectors to be identical in both its depth and the timing.
Yeah, no, that's valid, Keith. It's all about timing, and it impacts at different times and in different ways in different sectors. So I think that's great. So we talk about interest rates impacting over time. Maybe we can just expand a little bit on that.
Yeah, so the effect of an interest rate rise takes a while to work through the economy for some fairly obvious reasons. So most people have got a fixed mortgage. It's typically 2 years, which means an increase now doesn't affect their free income for a couple of years. The same with things like car deals. You know, if you've got a PCP or something like that, you'll have had an interest rate fixed at the beginning. The amount you pay per month won't change until you come to get the next PCP deal. So even if there are no further rises from today, looks as though there will be, there will still be a ratcheting of pressure on the economy over the next couple of years. And that's part of the difficulty of the central bank, is trying to manage that and trying to avoid overreacting in both directions, which it probably has done.
Okay, so turning to equity markets, what trends are you seeing with this kind of macro backdrop? And why do you think growth stocks have actually been devalued?
Okay, so the stock market is always a kind of balance between greed and fear. And in times of greed, when everything's going well, people want growth stocks. They'll give them higher valuations. The world will be more confident. There'll be more business confidence, consumer confidence, and therefore you can believe in growth stories more than you can in a recession, when people are typically cutting back on their expenditure. So that's one reason why growth stocks have been devalued. The other reason is a simple mathematical one, which is with growth stocks, what you're buying is future growth in sales, growth in profit, growth in earnings, whatever it is you want to look at. And what we do in the world is we discount that back to today's terms, because obviously a pound tomorrow isn't worth as much as a pound today. And so if that discount rate goes up, that discount rate is effectively the interest rate, the value of future profits, sales, whatever, falls. And that's another reason why growth stocks have been devalued, particularly growth stocks where there is no profits, or growth stocks where there are no dividends being paid.
Okay, so just moving on, I think inflation has really been the economic buzzword for the last couple of months. So what are your thoughts on inflation? Where are we going with that?
Okay, so I think for many people, this is the first period where inflation has become an issue. We've gone through a long period of very low interest rates and low inflation, 2-3% typically, and people thought it wasn't an issue. They didn't know about it, and there's probably a whole generation of investors who've never seen these sorts of conditions. So basically, economists think generally that a little bit of inflation is good for an economy. Deflation is not good, because in deflation, prices of things are falling, and that encourages people to keep their money in the bank, because the longer they can keep it there, the more they're going to be able to afford in the future. On the other hand, high inflation is bad, because it has differential effects between people on fixed incomes, for example, and those on variable incomes. So a little bit of inflation is thought to be the best thing. So the Bank of England's target has been 2% inflation, measured as CPI these days rather than RPI. It's looking pretty bad, actually. Now, who'd have wanted to be at the Bank of England in the last couple of years going through a pandemic, when there were periods you thought the economy might just collapse? And so they've been very generous, through keeping interest rates very low, through buying back bonds, but also the Treasury in things like the furlough scheme. So the difficulty was, when do you take your foot off that sort of accelerator, and how quickly do you do that? And how do you manage the economy through that? So it's been an incredibly difficult thing to do. In retrospect, it's probably going to be fairly easy to say they should have moved earlier in pushing up interest rates to offset inflation, because you've got inflation coming through both through the difficulty of the supply chain, plus the boom in demand that you saw. And so we are going to see a peak rate probably in the low teens next year. I think what the government has done on energy prices is clearly going to constrain it. But I think the issue now will be not what inflation might get to at the peak, but how quickly you can get it back down to the sort of the 2% level. And, if we're going to go through a range of pay increases as a result of strikes, train drivers and whatever, and that becomes a common theme across the economy, then it's going to be difficult to get that under control, and might well take a lot longer than the Bank of England's projections are suggesting. I think so in terms of investment effects, generally equities perform better than bonds in the long term through inflationary periods. And that's because most bonds have a fixed maturity payment, £100, and a fixed coupon, that's the amount they pay. let's say it's £5, that will not change whatever happens to inflation. There are some inflation-linked bonds issued by the government, but most bonds are fixed, and that means their value falls away in inflation. They get eroded. Whereas companies' revenues and therefore profits generated should be able to respond. So that's the broad macro thing. However, there are a couple of things to bear in mind there. So every sector's got its own inflation. It's not going to be the same across sectors. Secondly, I think investors need to look out for timing effects. So if I take an example, historically, what was happening in the packaging sector is that the input prices of paper and plastics, etc., would go up, but it would take companies between 6 and 12 months to pass that on to their customers. And in that period, life's very tough for packaging companies. Obviously, on the other side of this cycle, things are going to be great, but what we're looking at now is a pretty tough time. So think about the timing effects. You know, is the company and the sector you're looking at a price taker or a price maker? That's really important. I think the other thing to bear in mind is that the government's probably the largest beneficiary of inflation. It may not want to say so, it may not want to flag it, but it's a large beneficiary in several respects. So first of all, as I just said, bonds, government bonds, most government bonds have a fixed maturity price and a fixed coupon. The higher inflation goes in real terms, the less that costs. But there's also a term that I learned in my economics when I was at school and at university, which sort of fell out of favour, a term called fiscal drag. It's got nothing to do with RuPaul. What it's about is the effects of inflation on taxes. So, for example, you know, we start paying tax in the UK, income tax in the UK at £12,500. If they don't change that, which they don't automatically change that in line with inflation, more and more people will start to pay income tax. And that's true of lots and lots of taxes, thresholds and allowances, etc. So most of them are not linked to inflation. And unless the government gives you some kind of, unless it changes it, and in today's mini budget, there have been some changes, then the government automatically benefits from a rise in inflation in terms of its tax revenues. So those are the things to look out for. So I think the overriding thing to say is we are in a period where macro issues are the most important issues for investors. Probably for the first time for quite a long while. And when you get down to individual sector and company levels, you need to think about the timing of effects, the depth of effects, and you know, not everything is going to be equally affected by these issues.
Yeah. Okay, Keith, thank you. That's really helpful. I think it's going to go a long way in breaking down and cutting through some of the noise from these fundamental macro changes that we've been seeing. So if you're watching this video and you're interested in reading more on Keith's note, head over to the link in the description. You'll find the full write-up on the Hardman website. Keith, thanks again for joining us. To our viewers, please don't forget to like and subscribe to this video and our channel. We always appreciate your support. Otherwise, bye for now.